Okay, why don't we get started today? So good morning, everyone. Thanks for joining today's webinar. My name is Tom Citino. I'm the Vice President of Member Relations, and it's an honor to kick off today's webinar with everybody. And today, Frank Sperone, Managing Director of Darling Consulting Group, an asset-liability management consulting firm that consults with hundreds of financial institutions across the U.S., Frank will be discussing optimizing your organization's ALCO process. Before we get started, there's a few announcements I'd like to make. We do have an upcoming webinar in December. It's scheduled for December 9th, and that's going to be featuring our President and CEO, Jose Gonzalez, and Adam Goldstein. And they will both be hosting a year-end wrap-up discussing what has happened at the Home Loan Bank of New York and in the industry throughout 2021. So mark your calendars. That's December 9th. Also, we're planning a webinar in November, and we are still in the midst of finalizing our speaker. We want it to be worthy of your time, and we'll let you know about that in the coming week or two. So also, if you have any suggestions or areas of interest for future sessions, please reach out to your relationship manager or put some comments at the end. Getting some echo here. Okay, so just a few updates from the Home Loan Bank of New York. On Tuesday, September 4th, we had released $3 million in additional funds for a distribution of under our COVID-19 Small Business Recovery Grant. Those funds were exhausted immediately, but we were excited to see the impact our that the recipients received, and also we really appreciate the fact that our members were able to mobilize and get this money out to small businesses and not-for-profits in your communities, because it really makes a difference, and we thank you for those who participated. On Monday, September 27th, we did launch a new online system for our community lending program. So we have a new portal that got created. So those who borrow under our community lending program, you will need to use this portal from now on. This launch is a part of our continued effort to enhance and strengthen our online capabilities and enhance the member experience. As part of the CLP portal, you do have to enroll, and then there is a component there that you have to make sure you take care of. You have to, there's multi-factor authentication, and there's a RSA token that needs to be downloaded, or you need to request and activate it. So if you haven't done that, please think about doing that in the very near future. We're also going to be we also have some other web enhancements that will continue to improve our OneLink experience. So the new intuitive interface will be rolled out on October 18th, so another 11 days. And there will be outages over the preceding weekend on the OneLink IPR, so just to let you know about that. And finally, we continue to onboard members onto our new secondary market platform called the Mortgage Asset Program. It's a much improved outlet over our prior offering, and we're really getting some nice traction with that program. So please, if you haven't been engaged regarding that platform, that secondary market outlet, please contact your relationship manager to schedule a one-on-one. Okay, so just a few housekeeping things for this webinar. If you have any questions, please submit them at any time in the question box, and they'll be answered at the end of the session. And then also there's a survey at the end. If you would please fill that out, we'd really appreciate it. That would discern your interests and would outline some future topics that we could tackle in future webinars. So with that, let me hand it over to Frank, Managing Director of Darling Consulting Group, and he's going to commence with the webinar. So Frank, it's all yours.
All right, thank you, Tom. Welcome, everybody. It's no surprise. We're all wrestling with some real challenges. What's not so clear is what are the things that we ought to be thinking about in today's environment, given all of the uncertainties, all the anomalies, all of the things that we've never lived through before. We've done over 100 webinars since COVID. And I can tell you, we've gotten a lot of feedback, and we have a pretty good idea and a pretty good handle on what the issues are. the questions that you have and what you're struggling with. And so for today, what I want to do is I want to kind of walk you through what are the things that we need to do at ALCO, right, to affect change, to get things accomplished, to take action, to make a difference in 2022 and 2023. Most of us, 2021 record year. I would submit that, you know, everybody's had a record year in 2021 for obvious reasons. The bigger challenge, as we've been saying from, you know, the last many seminars I've done with you folks, is what happens next year. And so regardless of whether you model internally, you outsource it, I'm going to walk you through things that I think you can take to the next ALCO and have an open dialogue and a constructive dialogue that gets ALCO to take action and hopefully dispel some of the concerns and some of the fears that you all have that might get in the way of taking action. For some of you, it's board members getting in the way because of their concerns. Others, it's the Treasury Department. Others, it's the lenders. But regardless, we're going to kind of walk through what some of those things are and how we can have a more constructive ALCO meeting. So 2020, suddenly, all of a sudden, you know, as we're entering 2020, you know, everybody was concerned about a liquidity crisis. The reality is the liquidity crisis that we have today is not a lack of liquidity, but too much. And that's pretty much across the board. COVID hits and we've got this surge in the banking, and I use that as a verb, right? It is the greatest level of liquidity in banking history. It's turned banking, and again, as a verb, like if you're a bank or a credit union, insurance company, what you are, it's turned banking on its head. And we're all struggling with what to do, what's next, what are the concerns that we ought to be thinking about if and when things start to turn. For some of us, the biggest concern is and should be, what if things don't change? What if we remain in this low rate environment? Liquidity continues to build, margins continue to come under pressure, loans don't grow to the degree that we'd like them to agree. We have the lowest level of loan to deposit, loan to share, whatever metric you use in history. So banking has been turned on its head, margins are under pressure. I don't care if you're ROA or ROE, it's coming under pressure. What do we do with all of this liquidity? How do we manage this liquidity? How about interest rate risk? I would submit that when you run your interest rate risk analysis and you do your up one, up two, up three, I don't know if you ramp them, shock them, everybody should look better. But the reality is rates don't typically move like that. You've heard me say that before, and I'm going to show you some things that I think are important for you to understand when you're making some of your decisions based upon your outlook for rates and your exposure. Capital. One of the big things we hear every day is our capital ratios are coming down. What do we do? I've had people say, what do we do to get rid of some of these deposits? Many of you have swept them off the books, right, through promontory, interfine, whatever. Others are struggling with your capital ratios. And I always suggest that you focus on, forget about the tier one, right? Focus on your risk-based capital. That's the real number. And this is hopefully a temporary phenomenon. Don't get hung up that your capital ratio is down below your policy guideline. Your policy guideline is probably too high anyway, but we'll talk about that. And then deposits. Deposits that's the $69,000 question. And I'm going to walk you through just a couple of slides on deposit analytics. What are some things that we ought to be aware of when it comes to deposits? Where does all this deposit growth come from? And I'm going to just show you some slides that I think will be helpful, and it's consistent across the board. Whether it's coast to coast, everywhere in between, it's relatively consistent, the trends that we see. And we monitor this every single month with our client base, which is a pretty good cross-section. And I think that will be helpful to you in terms of some of the things that you may want to think about as we move forward. So, the pandemic, right? Once again, I've heard I've heard people say that Frank, I have no idea what our interest rate risk profile looks like. I don't believe it. I feel like I'm flying blind. So the question becomes, how comfortable are you with your interest rate risk profile? I'm going to walk you through 6 different interest rate risk profiles, right? These are your benchmark scenarios up and left, up and down, 1 or 2. The next one, we have a little yield curve twist. These are non-parallel yield curve shifts, right? All of a sudden now, rising rates is a little different depending upon the slope of the curve. And then depending upon when interest rates move and the shape of the curve, that also is going to influence what our interest rate risk profile looks like. The interesting thing about here is you look at all of these risk profiles, it's all the same institution. So the question becomes, which ones should we be focusing our efforts on? We've always said, listen to your balance sheet. That's going to ultimately lead to effective strategy discussion. If you look at the graph on the right, asset sensitive, whether the curve flattens, that F2 is flat up 2. So we bring rates up on the short end 200, we flatten the curve out. The other one's up 2 parallel, asset sensitive. How about liability sensitive? Well, we got a little near term with the orange if rates go up 2. If the curve flattens, as it typically does, it takes a little bit longer to get through that position. And then, the one in the middle is probably relatively well matched. Very few of you, and you've heard me say this 100 times, lack the capacity to put on long-term fixed rate assets. And I'm going to focus on that when we talk about strategy discussion. That's where the market is. That's where the demand is. There is slope to the curve. We need to extend out on the asset side, but a lot of stuff gets in the way. And I'm going to try to call through some of that things. Tom asked me a question, and so I slid this thing in here about match funding. That's a myth. If everything on your balance sheet was match funded and you had 0 interest rate risk, regardless of where interest rates go, then you might want to consider match funding. The reality is you have a mismatch that resides in your balance sheet, every single one of you, right? What happens is biases get in the way, right? I can't tell you how many clients that, I have that, you've got some older board members or older senior managers that they lived in the 70s and the 80s, and they're concerned about rising rates. And that gets in the way of them taking appropriate action. And that's nothing more than speculation, speculating on the direction of interest rates. That's not what we're trying to accomplish here. We're trying to manage our earnings, right? Not speculate. So that's going to influence some of the things that we do from a strategy perspective. If I were looking at your balance sheet, a client's balance sheet, and I'm looking at the shock scenarios, I'm looking at rates up 2, life is good. What I want you to think about is what if, right? And now let's just focus on the right here. What happens if rates don't move up for the next couple of years on the shorter end of the curve? That's where we have this delayed flat up 2 scenario. Short end doesn't move, and then as what typically happens, long rates start to move up, short rates follow, and then we get a flatter curve. Look at the difference in our beginning run rate of income, right, over time. What this shows is if rates don't move up soon and don't move up dramatically, our earnings ahead, unless we grow, it's a static balance sheet, no growth, our earnings are going to continue to go down, 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 down. That's consistent across the board. So where do we go from here? One of the most important things, I think, is that if your conversations at ALCO aren't different today than they were pre-pandemic, something's wrong. You need to change the conversation. We're in a different environment, and we could be down here for a while. And if we're continuing to manage the way we've always managed, it might not be sufficient to help us get through this environment. So we've got to change the conversation and look at things maybe a little bit differently. Look at things through a different lens. So for today's agenda, right? 6 things I think are important for you to bring to the next ALCO meeting. Number 1, what is the embedded net interest income pressure? For most of you, 80 to 85% of your income is probably net interest income. Some of you have fee income that helps, PPP, selling mortgage loans, etc. But for the most part, community institutions, that's the majority. That's the bread and butter of what we do, net interest income. And as that continues to come under pressure, we need to understand what is that pressure? How much is it? And then how do we fill the hole? You've heard me say that before. How do we go about doing it? What are the different levers that we can pull? So just step one, quantify what that number is. Number two, change the conversation on loan pricing. I see institutions that will not put on long-term fixed rate loans, regardless of what their pressure is and how much earnings pressure they have ahead. They're just not going to do it, which begs the question, why? Too much risk? Yeah. In my opinion, you're probably taking on more risk by doing nothing and selling things off or not entertaining. Loan pricing has come under pressure, and it's going to continue to come under further pressure the more margins come under pressure and the slower loan activity becomes. We see it everywhere. So change the conversation. I'm going to walk you through some things that I talk about at ALCO with my clients. Do your homework on deposit surge. Where did all this money come from? And as I said earlier, it's consistent. So the numbers I'm going to show you are consistent across the board, and it's probably consistent with what is happening within your organization. And then ask yourself, if I'm sitting a lot of excess cash right now, determine what is excess. And if I believe I'm going to have the same level of cash or more a year from now, what's preventing us from getting the money out on the curve in the form of loans or investment? How comfortable are you getting that money out? Right? We'll talk about that. Quantify how much capacity do we have. If you're asking me or suggesting that I put long-term fixed rate loans on, commercial, residential, how much capacity do I have to put on fixed rates? Well, we're going to walk through that. I've walked you through that every single webinar I think I've done for the last 20 years. We're going to go through that again quickly. And then look at asset strategies through a little differently. Look at it through a different lens. And at the end of the day, set the tone now for deposit strategies now and going into the next rate cycle. I had a meeting this morning with a client and I went through about 15 slides on their deposit base. And we did all these analytics for them to get them to understand where did all the money come from. And I have these slides in here. I actually slid them in this morning and resent this to Tom and Alyssa. Where did all the money come from? Are they existing accounts, or how much of it is new? And what are the tiers it came from? And I'm going to show you in a minute. It's very consistent across the board. It kind of opened up their eyes, right? And we looked at the different tiers. We changed pricing. We changed tiers. We made a lot of decisions today that made a huge difference. Just walking through the deposit base. And I'm going to walk you through those, right? So number one, quantify how much pressure you have. One of the things that I think masks a lot of the earnings pressure that we have within our balance sheet is all these PPP fees. If you look over at the left here, you can see earnings drop off rather significantly at the end of, or 3/4 of the way through year one, and then it drops. That's a lot of PPP related income. But even after that, if I look longer term, the graph down at the bottom, it continues to go down for obvious reasons. This low rate environment. Every loan you book today is at a lower rate than the average in the portfolio. Same thing on the investment side, and there's very little room to go on the liability side. So 2022 and 2023, that's years 2 and 3 here, and that's beyond that. It's even worse. Expect to feel pressure. The question becomes, how do I fill that hole in earnings? And in this particular case, it's $1 million. What are the things that we can do? Well, we'll talk on the deposit side. How much room do we have there? But I think for a lot of us, that doesn't move the needle to the degree that it would be if we did other things, such as, what if I did $100 million of bond purchases at a 1% spread? That's what I did for this client today. I showed them 75 million, and I'll show you the strategy at the end. That's immediate income. It doesn't take any time. Loans, on the other hand, that takes time to originate. But if we can originate loans, I only have to do $30 million worth of loans at a 3.5% spread in order to get the same level of income. So which one bothers you more? Maybe it's a combination of the two. The important thing is to quantify what we need to do, where our levers are to get to where we need to be at a minimum, just to fill that hole. And as the clock turns, right, on January 31st into 2022, that's when I think a lot of the challenges begin and start to accelerate. So how much loan volume do you need? And by the way, as I said earlier, you can do this within your own ALCO process, right? Number one, how much volume? If I just look at the decline in earnings, why am my earnings declining? Well, as I said earlier, how much of it's related to my loans? How much of it's related to my investments? Well, in this particular case, I just want to look at all the loan cash flows coming in over the next year. And in this particular case, it's 302 million, 301. The weighted average rate, right? When we look at it, it's in the low fours. So if all we do is replace those dollars, right? Our income is going down because we're booking loans today at a weighted average rate of 375. For some of you, it's even lower than that. So how much volume do I need to put on to get to the same level of income? And in this particular case, right, it's about 4 to 6% loan growth just to retain and maintain a neutral level, right? And you can see down here, you know, what's running off, how much we have to originate, at what rates to have the same level of income. So frame the real issue. And this is important when we get to the loan portion of today's session, and we talk about what loans are we losing because we're not willing to hold on longer term fixed, or we're not willing to come down to these levels because they're too low. Every time you say no to a 3.25%, 3.5% fixed commercial or residential loan, you're saying yes to what? Cash at 15, right? You can't afford, most of us can't afford to do that, right? All the quality loans you get your hands on, if your capital supports it, grab them. The interest rate risk piece, I'll get to that later. But don't be so concerned about the absolute rate level, and we'll talk about that. Let's talk about loan pricing. What's driving the market for loan pricing? We know margins are under pressure, and it's not just margins, it's earnings. And as margins continue to come under pressure, you know, it's finance 101, economics 101, we're going to have to make up in volume in the near term what we're losing in spread. And for those of you that say, I can't live on 3.25 margins, or 3.25 yields, because I got to maintain a certain margin to cover my overhead. Well, the reality is, if 3.25 you can't live on, or 3, then you can't live on 15 basis points either. These concerns, earnings concerns, are real. A lot of institutions are more comfortable with the credit outlook. What does that have to do with anything? That's driving down credit spreads. It's reducing absolute rate levels because there's fear, there's less fear that these things are going to go bad. Sitting on cash, it's the opportunity cost of sitting on cash with no end in sight that I can't continue to let cash build. I've got to get the money out. And that's, again, what's driving down yields in the market. And so a lot of institutions are willing to accept lower spreads. I want you to focus on spread versus the absolute rate level. Some of us may have said, geez, I'm not going to hold any long-term fixed rate anything with a 4% handle. Then it was 350. Then it was 3.25. And then all of a sudden now you're realizing if you're not willing to do that, you're losing deals. And you're losing some of your best customers. And I'll tell you one of the big issues that I'm seeing, lenders are leaving. They're leaving institutions to go to other institutions because they say, you know what, I want to make loans. I can't make loans at this institution because all the demand is for products that we're not willing to entertain here. I'm leaving, and they've left. And the last thing you want to do is lose lenders. So set the tone and the parameters for how low will we go. And it doesn't have to be every single loan, but maybe you carve out a pool of X amount of dollars and say, if I have to get down to this level for these customers, I'm doing it. For these members, I'm doing it. I'm not letting them go, right? So let's just do a little reality check on loan pricing. And again, these are things that you can bring to ALCO. And I don't care if it's residential, I don't care if it's commercial, but if we look at 5-year fixed rate commercial real estate deals, it's common around 375. I see them at 3. I see them at 275. Some markets are more aggressive. If you think about pre-COVID, rates were higher. We were getting somewhere 4.25, 4.5. If we look at spread, forget about the rate level. Look at spread. Back then, it was like FHLB plus 235. That's where we were. LIBOR plus 275, and it was somewhere around prime to prime minus a quarter. That's about where we were. I did this as of September 17th. I looked at them yesterday. They're about the same levels. So I didn't redo the whole thing because it would have taken me about 2 hours to do the slide. So FHLB 5-year, it's around 110, right? So let's just take a look at today. If we're doing fixed rate deals at 350 to 375, and I look at it on a spread basis, FHLB plus 240. We're actually getting higher spreads today than we were getting pre-COVID. And I can tell you that some institutions and some of the larger institutions that we work with, they're doing things at 3% and sometimes even lower. But let's just say 3%. Some of you have loan pricing models, or some of you say, that's the rate. We're going to do FHLB plus a spread, or LIBOR plus a spread, and you're losing deals. Is it crazy to do these deals at 3%? If I convert that to LIBOR, effectively, it's LIBOR plus 216 in a world that used to be 175 to 2. So it's ironic. Some people from Chatham are calling me now. They must know I'm talking about swaps. Anyway, that's the important thing is make sure that you understand that spread in today's market is no different than it was pre-COVID, and we're in a low rate environment. Absolute rate levels seem lower, but the reality is, right, if you really wanted to lock in that spread, and you don't want to go out 5 years and worry about rising rates, you can put a swap on if you want. You can buy a cap. You can lock in FHLB. But regardless, the most important thing here is it's the reality on loan pricing, and I hate to see you lose deals because you're so focused on the absolute rate level. So that's on the loan pricing, primarily for commercial real estate. I'll talk a little bit about resi a little bit later. How about this deposit surge? This seems to be the hot button. And the question becomes, how much are you comfortable with? Because a lot of us are sitting in a lot of excess cash. We're not talking about advances today because the last thing you want to talk about is borrowing money when you're sitting on hundreds of millions of dollars. So most important thing is let's just take a look at the COVID surge. If you just look at historically, and this is consistent, again, across the board, what was your normalized growth rate, and that's where the green COVID surge line hits the blue. If I just run that blue line out, and this is for a client that I work with, that's your normalized non-maturity deposit growth. I'm just going to keep that line moving forward. COVID or no COVID, that's what I would expect deposit growth to be. All of this excess, right, that came in as a result of COVID, where do we go from here? Well, we know what the surge is. We know what the dollar amount is, right? We know what that percentage is. The question becomes, how much of it's going to stick around and for how long? So the very first step for all of us to do is identify where that money came from. That's just like raw materials inventory, right? It's money, right? Segment new accounts versus existing accounts. I would submit that probably 85% is all new money that came in from existing accounts. Average balances are higher. I'm not telling you anything you don't know. I also want to know where the new accounts are. Who are they? What's in there? How many accounts do they have? If you break out business versus consumer, it's eye-opening. If you drill down even deeper, right, and you look at the breakout of these deposits based upon average balances, what you're going to find is the largest balances, above 100 and above 250, that's the lion's share of the money that came in here. So the big question becomes, what's going to happen if and when rates start to move up? Until rates start to move up, our data scientists group, they've done studies back to the Flintstone age, and their expectation is money's got to continue to grow in these accounts. But what I would want to do, and I think is important, is take a deeper dive. Where is all this money hiding? Again, there's a lot of numbers. The most important thing here is if we look at relationships, right? Balances less than 25,000, right? Look at the concentration of these things relative to the larger balances, 25 to 100, and then above 250. That's where a lot of it comes in. And if you break it down, what you notice is about 85%. 85% of that growth is in business accounts. It's high balance business accounts. Again, we can walk through 15 slides, but the reality is, right, the deeper you go in this, the more you're going to find that in this particular case for this client, I had this discussion this morning, they've got 20 accounts that have more than $5 million. And if you look at the average balance of these accounts, you see it in the green line, all of a sudden where that blue star is, COVID hit, now look at it. The average balance went from 2.5 to over 5 million. You think that's temporary? Or you think that's going to stick around, for long, right? That's for you to decide. But that's of that surge deposit, right? I would want to know, where did it come from? And of these 20 accounts, I would be on the phone. I would be talking to these people to get a better handle on what's going to happen. You can drill down as deep as you want, take those accounts and look at, who are these people? I have all the relationship numbers. I don't have the, but you can track these things. And that's going to give you a better handle on where the money came from and the probability that that money is going to stick around if and when rates start to move. And it's really not until rates start to move up where you start to see that money migrate out. I make a joke of this, have a pizza party. All I'm saying there is invite people in and have a conversation on what's going on in their business, why the money is building, what their plans are, what their expectations are. The core accounts, the smaller accounts, that's a lot simpler. This is the one I did, again, for my client, and just showed, as I showed you earlier, this is the normalized growth, that blue line. And if you're concerned that 100% of the deposits are going to leave, let's see what that looks like. That's scenario 2. If I roll the clock forward to the end of 2022, our normalized growth, if I run off 100% of the deposit surge, I still have more deposits than we had pre-COVID. We don't think that 100% is a reasonable number. But even if I ran off 50%, right? Look at the level of deposits a year forward, even if we were to run off 50%. Now, why is that important? It's important because right now, if we're sitting a lot of cash, we probably ought to put it to work without fear that we're going to have to replace this, or, God forbid, we got to turn to the home loan bank and borrow money because all the money left. That would be the best thing that could happen. Everybody on this phone, loan demand picks up, rates pick up, life is good. The bigger concern is you sit on that cash and wait and hope that rates go higher, right? So even if I were to assume 25% runoff, this is like the sensitivity analysis. You can all do this. What you're going to discover is, even if I run that off and I run the clock forward, I'm going to have still more excess cash than I need. So 5 important action items. Quantify the magnitude. Where did it come from? What's the likely outcome moving forward? Go to the extremes. 100%, 25, 50. We think it's more toward the middle. And then if I'm going to have all this excess cash, talk to the lenders. How much is this going to get? How much of this excess cash is going to get absorbed in loans? And maybe rather than sell loans, maybe we hold them. Maybe we entertain some of those loans that we weren't willing to accept before because we were concerned about rising rates, interest rate risk, unrealized losses, right? And again, use those outcome bands to kind of shape your strategy. Look at the extremes. And even when you look at the extremes, I think what you'll find is, yeah, we can still do that. There's no need to be concerned. So once we've gone through all that, now the question becomes, all right, we can put on some fixed rate assets, whether it's loans or whether it's investments. How much can we do? Well, you've seen this before. What's my real asset sensitivity? On the right side over here, this is pre-COVID. This is at the end of 2019, when many of us were worried about rising interest rates. Remember that? Fed's going to raise 3 more times. Rates are going up. And when in fact, we exactly went the opposite way. But we had a little exposure. Notice the inflection point here. Even in that rising rate environment, once I get to the second year, life is good. That's why it's important to look beyond 2 years. Don't just look at year 1, year 2. I see a lot of ALCO models. I get piles of them over here that I get to go through. People that send them to me and take a look at. A lot of them go out 2 years, or they go out 2 years and they have shocks. If I look at 12/31 of 20 after COVID, I think, well, gee, look, same institution. What happened? Did my business model change? Right? So there's probably, for some of us, we might have a little more exposure to rising rates than what our models show. Example 2, same thing, right? Pre-COVID, COVID. So the reality is we need to have a pretty good handle on what does our true business model look like, and as things change, as rates rise, what do we anticipate in terms of the change in mix to our balance sheet? And a lot of that's on the funding side. So rates have nowhere to go but up. You've heard that before. Most of you have capacity to add duration, add longer assets. Why don't we add more duration? Well, because we're concerned about rising rates, I think. Because I've yet to find an institution that has a lot of exposure to rising rates. And even if they do, doesn't mean don't hold fixed rate. It just means manage it. And for how long? That's when we get to the inflection point. And that's where you have to have a clear understanding of your risk profile. And so there are mixed messages out there. If we look at our earnings at risk over here, but then we look at our EVE, or for the credit union, this is NEV, it says, oh, geez, but look at, we lose a lot of value when interest rates go up. Well, the question becomes, what's more important to you, earnings at risk or value at risk? That comes up when we talk about putting on fixed rate investments. Yeah, but that's what's going to happen when rates go up. We're going to have unrealized losses. The best thing that can happen, all of you, is you have unrealized losses in your investment portfolio a year from now. Because what that means is rates are higher. And unless your investments are more than 50% of your balance sheet, that means as rates rise, you're getting higher yields on cash flow, loans, demand is strong, the economy is picking. That's all a good thing. And by the way, what's funding those underlying securities? That's the important thing, right? It's not, high price money market, highly rate sensitive money market. It's your core funding. And we're going to go through that again, as you've heard me go through 100 times. There's the inflection point. Even if I've got exposure, we're asset sensitive over here, clearly, but even if I've got a little bit of exposure for the first 2 years, beyond that, life is good. It gives me a lot of time for a lot of my balance sheet to cycle through. Most of us have the majority of assets repricing within 5 years. Some of you are even shorter, right? So let's look at the core funding utilization of this institution. I'm going to assume rates go up 200, and I'm going to extend the assets in my balance sheet rather than just use a base case, rates unchanged. Rates up 2 from here, what does our balance sheet look like? Well, if I look at my balance sheet, assets that are repricing beyond 5 years, how much do I have? $421 million. What do I have in the way of long-term non-rate sensitive funding that I can use to support that? $1.15 billion. So that means I've got $736 million of long-term non-rate sensitive funding that's not funding a long asset. So you could put $1 billion on it if you wanted to. And of the billion that you book in long-term fixed rate assets today, if I roll the clock forward 5 years, it's probably going to be less than 736 because of amortization, cash flows, payoffs. The reality is you have so much that capacity that you shouldn't be worrying about booking long investments, booking long loans. All of you should be doing this. Okay, asset sensitive. If I'm asset sensitive and I add duration, right, that actually reduces my risk. I've got higher levels of income, right? Look at the green. Whether rates stay the same or rates go down, I'm much better off. Even if rates go up 2, I'm better off by putting $200 million of cash out into commercial real estate. This is an example of an institution I work with that was losing a lot of commercial real estate deals because they wouldn't go out far and they weren't meeting the market demands for rate. they did after this, after showing them this. So I thought it'd be a compelling argument for you. What's the only scenario under which there's an opportunity cost? Well, in year 3, 4, and 5, it's a couple $1 million a year on 200 million. But by the time I get to year 3, look at year 3 up here. Up 4 is my best case scenario. I'm not funding this out of short-term borrowings and money markets. I'm funding it out of my core funding. That's an opportunity cost I'll take all day long. So don't get hung up on, what happens when interest rates go up, right? Even if I were to assume 25% of the surge runs out the door, does it still make sense? The answer is yes, it does. These are the things that I think will give folks at ALCO a little bit more confidence and intestinal fortitude to take action on the things that we talk about. I know things get in the way. So when we talk about your capacity to extend, understand the interest rate risk changes that have taken place in your balance sheet post-COVID, right? Yeah, there's some anomalies there because of all the non-maturities that have come in the low rate environment. But this could be the new normal too, this low rate environment. Understand your core deposit stickiness from the surge. I showed you those different bands. I showed you the normalized growth. You're probably going to have more deposits down the road than you may think, right? Understand the changing yield curve. Parallel, everybody looks better. I would want to know what I look like in a flat yield curve. And if rates stay down for, let's say, another year or 2, right? And if you're still comfortable, then again, that should give the intestinal fortitude to take action. We could spend a whole morning talking about deposit sensitivity. As rates rise, what are we likely to do in terms of our deposit base? I have all that information from thousands of banks across the country going back 30 years, 3 billion data points, if you want it. I can tell you that for the next 50 to 100 basis points of Fed tightening, if and when it happens, banks barely move those. It's not until we get beyond that where you start to see elevated levels of increases. So I would model that into my balance sheet as well, as opposed to just linear betas, right? We talked about core funding. And again, I talked about looking at simulations beyond 2 years because you have that inflection point. Heck, if all you do is go to your gap report, look at your gap report and look at the cash flows coming in, right? That'll give you a pretty good feel for the crossover points within your balance sheet. And then last but not least, how about asset strategies? Let's look at things a little differently. Okay, we've got 15 minutes left. I'm going to spend 5 minutes finishing this up. And Tom, I just got your text message. And then we'll set aside 10 minutes for Q&A. So everybody wants long-term fixed rate products. How much can we support? I walked you through that core funding utilization. If your balance sheet looked like this, right? This is at the end of 2020. This is that commercial bank I was telling you about, right? A lot of pressure to earnings going down. I said, let's just start with a big number, right? They wanted to see what 100 million. I said, let's do 250, right? Instead of 100. Let's start with a big number and see what it looks like. Look at the difference between booking those long-term fixed rates versus not booking them and sitting in cash and letting those deals go away. We're better off in every single interest rate environment. It's all modeled out. Then the question becomes, yeah, but what happens if we lose deposits? I'm going to go to the extreme. And I'm going to go to the extreme and I'm going to say, what happens if 250 million of deposits run out the door, right? And if 250 million runs out the door, right, we're still better off. What if I don't have a lot of excess cash? And by the way, I was talking to Tom earlier, we've got clients that are borrowing money still, and they're going to look to borrow more money next year. Why? Because they're not sitting in cash, they're putting it all to work, right? They're not sitting around waiting and hoping that rates go higher. They can't afford it. So if you're exposed a little bit to rising rates, once you get beyond 2 years, in this case, heck, if I'm really concerned about putting on long-term fixed rate, I don't care if it's 10-year, 30-year mortgage, whatever, I don't really need a lot of protection once 2 years forward. I might put on 2-year borrowings on the bank at 35 bips, right? Current income versus future income, right? I know if in a rising rate environment, I'm going to have higher levels of income. If rates go up, I can just take out a little bit of that exposure to rising rates. Quite frankly, I would. Would I find out 2 years? I don't know. Maybe, maybe not. I probably wouldn't. But if it makes you feel better, right? How about residential lending? For a lot of us in 2021, yeah, pretty darn good. We made a lot of fees. All of a sudden now, with PPP going away, secondary market outlook is slowing. We're not getting the same level of fee income. Maybe we ought to think about next year and the year after, and maybe talk about the break-even dynamics for selling versus continuing to grow our loans and having an annuity stream of asset yields at 3.25-ish on residential mortgages versus taking the one-time shot. What are the important considerations? It's our earnings outlook, right? You want fee income today or more income next year and beyond. The reality is, for most of us, 2021's in the bag. We have record profits. It's the following years that are going to be. So create the annuity stream at 3.25, whatever your mortgage rates are, versus taking the one-shot pony. If interest rate risk is an issue, again, look at those inflection points. We can always manage that. And if you really wanted to hedge some of that, yeah, you could through swaps. You don't need to borrow money if you're sitting on boatloads of cash. You can do it through a derivative, right? We all know that. How about on the investment side? We've gone through the loan, gone through deposits, right? And by having gone through a deposit strategy and our lending strategy, what's left at the end of this, right? So at the end of all this, now we go to investments. It's the last thing I would look at unless I didn't have the loan demand. So what really moves the needle, right? Putting out, a few $1,000,000 here or there, that doesn't even move the needle, right? What are our tiebreakers? What are our investment objectives, number one? And then number two, what are our tiebreakers, right? Versus doing nothing, right? Always establish those. There's no free lunch, do your homework. You've heard me say that over and over and over. One of the things I hear all the time is, well, geez, how about unrealized losses, Frank? We put them on. Should we put them in the HTM, AFS? Unrealized losses in the investment portfolio are a function of the long end of the curve moving up. If the long end of the curve moving up, your income goes up, and the funding that's supporting all of these assets that we're booking, if we're doing it properly, the value of those non-maturity deposits goes up at a greater level than the unrealized losses in the investment portfolio. So look at it on a holistic basis. Net in a rising rate environment, my EVE or my NEV probably looks better because of the value of those low cost, no cost core funds. Don't get hung up on looking at things in isolation. Again, you've heard me say that a million times. For some of you, you got a lot of cash flow pouring in next year. Every so often, you get these little backups. We get a 10-year at 154, 152, right? Rather than wait for the cash to come in, why not go borrow, pre-invest, and buy the securities today and hope that rates go up between now and next year? That would be, maybe an opportunity cost, but life is better if rates go up. The bigger risk is rates don't go up, they come down, right? So pre-investment, it locks in income today immediately, right? So a little temporary leverage, might be appropriate for some of you. Last but not least, deposit strategy. Now in the next cycle, we talked a little bit about that and what's going to drive the deposit market. Number one, how fast will loan demand accelerate? With all the excess cash out there, I can tell you, we see clients that deposit rates that are so low, they're almost zero. And until loan demand picks up, all this excess liquidity, there's not a lot of pressure on deposit rates. Until all this stuff is absorbed, you're not likely to see pressure on deposits. Will customer behavior patterns repeat? Well, I don't know. It depends. It depends on a lot of things, right? But the reality is I can go back to pre-COVID and look at the mix of my balance sheet, change everything back to the same mix you had before, and then see what does that do to our earnings at risk? What does that do to our core funding utilization? And once you do that, you can all do this. It's pretty simple. Now you've got a better handle on how much you can do in terms of longer term fixed rate funding without worrying about rising rates, and what you might need in the form of deposits moving forward, right? How how comfortable will you be letting some deposits go? That's the whole marginal cost of funds argument, right? And the reality is, after having gone through what I walked you through early on, all those excess deposits that are coming in, if you want to price your deposits in a rising rate environment to retain all of them, it's much too expensive. And if you do that, you better make sure that they're core deposits and not fair weather friends. Unfortunately, for some of us, right, when we start to see money roll out the door, we just automatically knee-jerk raise our rates. Or we look at that, deposit survey, right? Those are the rates that nobody pays anyway. Okay. You know what? I would stress test my deposits. This is simple stuff that you can do. I would double the betas, see some shifts, and then say, what do we look like in that case? And the reality is, near term, you might have a little more exposure to rising rates. Longer term, you still have capacity to book long assets, right? One of the things that I think some of us lose sight of is when we look at short-term interest rates and we look at short-term deposit rates, we think that they're very closely correlated, and they have been historically. The reality is, this time around, long-term rates have come down so much that all of a sudden now, margins have come under so much pressure that long rates are driving down income and margins to the point where now short-term interest rates, all things being equal, if we went back to other rate cycles, our non-maturity deposit rates should actually be negative to have that same relationship. It's the first time it's happened in my lifetime, right? And that's kind of what that graph over on the right is. So what that means is, for some of us, we should have the intestinal fortitude now to lower our rates even further. And a lot of you have a lot of opportunity to bring your rates down further on the non-maturity deposit, whether you realize it or not. So take a closer look at that. That's a simple one. The first step, which I've always said to you, is you got to get the position right. Once you get your risk position right, both on the interest rate risk side, on the deposit side, on the liquidity side, then the rest is easy. Everything just kind of jumps off the table. So make sure you got good information, you get the picture right, add some clarity, right, and perspective to your ALCO process, because I think it goes a long way. And even though a year ago we may have had a little exposure to rising rates, and today we don't, even if we would revert back to, the good old days, we still have capacity to take action today, namely putting longer assets on the books. And again, you've heard me say this over and over, right? That the best informed people ask good questions, and it leads to better solutions and answers at ALCO, right? And so there are no answers. When you look at your ALCO package, there's no answers. It should generate a lot of questions. And a lot of the things that we walk through today, those are the questions that I think are important for you to ask. We're in a low rate environment, but regardless of where we are in the rate cycle, rate environment, listen to your balance sheet. You've got a living, not breathing, but you got a living balance sheet. And I showed you all the different interest rate risk profiles. Listen to what it's telling you and take appropriate action. Take out the biases. Unfortunately, all too often, those biases get in the way of us taking action. Some of you have heard, seen me do my presentation years ago about, I think this was at the end of 18 going into 19, where a lot of institutions were worried about liquidity. They're worried about rising rates. And they said, you know what? You guys are all taking action that's the opposite of what you should do. You ought to be shortening funding and lengthening asset in anticipation of a Fed tightening cycle. And that's got the old, George Costanza, do the opposite. And sometimes it's probably the right thing to do. So, kind of tongue in cheek. So at ALCO, change the conversation. It should be different than it used to be. Look at things a little bit differently. It's a paradigm shift. And, for some of you that have been around, for a while, you may have seen this book, you may have read this book, Who Moved My Cheese? If you haven't, you can read it in about 20 minutes, but it's all about change and how we anticipate change, how we manage it, how we adapt through it. Enjoy the change. This is tough times, very difficult times. None of us have ever lived through this, but be ready and change quickly. And then ultimately we'll come out on the other side so much better. Don't fear the situation that we're in now. At the end of the day, we'll get through this. It's it's little incremental decisions along the way, but again, executing with confidence. So with that, that's the end of my presentation. We've got about 5 minutes for questions. Tom, you sent me a couple of questions, but I didn't read them, so sorry.
Yeah. Oh, thanks, Frank. This is a great presentation. Getting a little echo, Frank. Maybe put it on mute for a minute. So when we have a few questions. So one question someone had is, when we do start moving into a higher rate environment, do we have to be prepared now, or is there levers to pull and strategies to embark on the fly as that emerges in front of us?
Okay, Tom, can you hear me?
Yes, good.
Yes, good. Okay,
very good.
Good. Yeah, you know what? Have those plans in place now. I talked about betas. How are we going to move our deposit rates? Which ones do we move? One of the things we recommend is in a rising rate environment is, hold back. Number one. Number two, introduce new products. So you're not pricing everything up all at once. I mean, there's a lot of little strategies, but if you're managing properly, right, then all those things should not be a concern. You don't have to necessarily manage on the fly. And that's why you do this every single quarter. I think the short answer, Tom, is don't worry, don't fear rising rates. If you're managing, on a quarterly basis and you're having good dialogue at ALCO, you're gonna have a pretty good understanding of what's going on and what needs to be done, so that you don't have to hit the panic button, which some of us do when rates are rising. Rising rates is your friend. Remember that.
Okay, thanks, Frank. Another question related to inflation. What's your biggest concerns as you're heading into an inflationary environment? And then what strategies could you think about now in order to prepare?
Okay, so, as far as inflation, I grew up at a time when, interest rates were 21%, 18% when I was in college. That to me is inflation. Some people talk about inflation, and that's what they think about. Others think about inflation and think about, rates going to 5% or 4%. The reality is, there are, in my opinion, no signs of major inflation that would create any risks to the banking industry. So I think it's relative. When people talk about inflation, anytime we see inflation, what happens? The Fed raises rates, they overdo it, they tighten too much, rates come right back down. I just don't see the same parallels between, the current environment that we're in today, in today's world, and technology, and all the things that have kept inflation down and low, and in many parts of the world, deflation or disinflation. Those are the bigger issues, in my opinion. So again, inflation is a relative term. Do I think rates have room to move up? Yeah, a lot. No. And again, we're not economists. We don't gamble on the direction of interest rates. But one of the things I can tell you is, I would be less concerned with inflation, because the economy is picking up. Unemployment is low. Loan demand is strong. Those are all good, positive signs, right? You can manage through, different rate environments. At the end of the day, it's credit quality that is the big concern that I would have when it comes to anything related to inflation.
Hey, Frank, thank you very much. We've run out of time. It's 12:01. Thank you. It was a great presentation as always. Thank you to the attendees as well. If you had any questions regarding this session, please reach out to your relationship manager, and then we could get those questions directly over to Frank, and Frank will be pleased to answer all of those. So again, thank you very much, and thanks, Frank, and we'll see you again soon. Okay. Have a great day, everyone.
Thank you. Thanks, everyone.